So Upstart just dropped their Q3 numbers, and on the surface, things look great. But here's the twist. Their own AI decided to pump the brakes. Why? We're going to break down this story of calculated caution, you could call it, straight from their CFO, Sanjay Datta, to really get what's going on here.
All right, so right out of the gate, the CFO, Sanjay Datta, gives everyone the headline they wanted to hear, right? Healthy growth, back to making a profit, sounds perfect. But, and you know there's a but, that's not the whole story.
Yeah, because the really fascinating part isn't just the big, flashy numbers, it's the story behind them. You've got a company that's doing really well, but at the same time, they're deliberately choosing to be more cautious. So, let's dig into why they do that.
And that really sets up the core theme for the whole quarter, doesn't it? It's this tension, this balancing act between pushing for growth and practicing some serious prudence. Let's take a look at how they juggled that and what it actually meant for the bottom line.
Okay, so here's that tension, laid out plain and simple. On the one hand, you've got this great news, healthy revenue, strong profits. Awesome. But on the other hand, transaction revenue, which is a huge engine for them, was just a little bit short of what they'd hoped. And believe me, there's a very specific reason for that.
All right, before we dive deeper, we got to get one key term down that the CFO talks about a lot: contribution margin. Now, don't worry, it's pretty simple. Just think of it as the profit Upstart makes on its fees for each loan after you strip out the direct costs like marketing and verification stuff. It's a super important metric for understanding the health of their business.
So, that number landed at 57% for the third quarter. Now, that's still a really healthy margin, but it is down one little percentage point from the last quarter. And the reason why is pretty interesting. Lower conversion rates actually made their costs go up a bit. It's just a perfect little example of how even these tiny tweaks from the AI can have a real ripple effect on the financials.
Okay, so with that context set, let's get to the good stuff. The main event. Here are the hard numbers that really tell the story of Upstart's Q3. First up, total revenue. They brought in a whopping $277 million. And get this, to show you the kind of momentum we're talking about, that is a 71% jump from this time last year. 71%.
And wow, the platform was busy. I mean, they processed 428,000 loan transactions. To put that into perspective for you, that's a mind-blowing 128% increase from the year before. Just incredible growth in volume.
And then we get to the bottom line, what everyone really wants to know. GAAP net income came in at $32 million. And you know what? That was way better than anyone was expecting. It was mostly thanks to some strong interest income they made and just keeping a really tight lid on their costs.
So when you put all these numbers together on one screen, you see the huge jump in revenue, the solid income from fees, and that great profitability. I mean, by any measure, this was a fantastic quarter, which of course brings us right back to that big question.
All right, let's finally tackle the why here. With all this great stuff happening, all this momentum, why on earth did Upstart's own AI model decide to, gently tap the brakes?
I mean, that's really the million-dollar question for this whole thing, isn't it? Normally, when things are going this well, your first instinct is to floor it, right? Put the pedal to the metal. But Upstart, they did the exact opposite. So let's break down exactly what they were thinking.
So the CFO laid it out for us, step by step. It's a simple cause and effect. First, the AI model started seeing some, let's call them yellow flags. It saw a little jump in their own macro index that tracks risk, and it noticed people were repaying loans at a different speed. So what did the model do? It reacted. It automatically got a little more conservative, which meant fewer approvals and slightly higher rates. And the end result of all that? Well, that's the small miss on transaction revenue we talked about earlier. It was a very clear trade-off. They chose to focus on the quality of the credit over just sheer volume.
And this quote from Sanjay Datta, it really says everything you need to know. This wasn't some fluke or an accident. This is their core philosophy. He literally calls getting credit performance right their North Star. They just have this fundamental belief that you have to trust the AI, even when it tells you to slow down, because that's what's going to lead to the best results in the long run.
Okay, so that was a look back at a quarter of very intentional caution. But what about the road ahead? What's the plan now? Let's take a look at Upstart's official guidance and see how they're planning to wrap up the year.
All right, so these are the big assumptions that are kind of built into their forecast for Q4. And what's really interesting is that they actually see consumers slowing down their spending as a good thing for credit quality. So you take that, you add in a stable economic outlook, and the fact that their tech just keeps getting better, and yeah, they're feeling pretty confident, even with that typical holiday season slowdown that always happens.
And here are the actual numbers they're targeting. For Q4, they're looking at about $288 million in revenue. And for the full year, they're hoping to cross that huge $1 billion revenue milestone and bring in around $50 million in net income. All in all, a pretty solid plan to finish out a really strong year.
So that leaves us with this final big idea to chew on. Upstart's whole story this quarter is basically a big bet. A bet that in today's tricky economy, the smartest play isn't always to just go faster and faster. Maybe it's about trusting your system to navigate for you, even if that means slowing down. The real question for Upstart and for all of us watching is this: could it be that in today's world, this kind of calculated caution is actually the boldest move you can make?